Most people think that we can make money with stocks by predicting price movements. And of course, this is kind of true. Because obviously, if I put money into a stock that's at a certain price, I do it because I want it to be at a higher price later, so when I sell the stock, I will have a profit. Obviously, this is the goal. Of course, nobody puts money in a stock because he wants to have less money later. So yes, in a certain way, we want to predict the price movement of a stock. But I think there's a huge misconception around this. Because most people think that we can predict prices by looking at the price chart. They think that if the price of the stock is going up, they can buy it and it will still go up. And then they will somehow predict when the stock stops going up and they just sell it just before it starts to go down. This is a very typical misconception about stocks, but in reality, nobody ever had success doing this, not over the long term. Sure, some people get lucky once in a while, but there's a reason why there isn't anyone amongst the wealthiest people who became rich day trading. So, long story short, nobody can predict the short-term movement of the prices, especially by looking at the price chart. So, anybody who tries to do that is just gambling. But we can predict the price movement of stocks over the long term. Because over the long term, stock prices cannot differ from the real value of the underlying company. We know that when we buy a stock, we become one of the owners of a business, a company that generates money. But there isn't any rule or law that determines that the price of the stocks must be the same as the real value of the company all the time. The price of stocks is determined by the judgment of thousands of investors who bid and kind of vote about the prices. So over the long term, this collective decision works efficiently, over the long term. So when we look at the data of a certain company, we see the growth rate of the company, we see how much money it generated in the past years, how fast the revenue grows, and based on these data, we know that if the company just keeps doing what it has done in the past, then it will grow in the future, therefore the price of the stock will be worth more in the future. This is how we can predict if a stock will go up. If the company grows, then the stock will be worth more in the future. But this system is not perfect. Over the short term, prices can differ from the real value of the company. So over the short term, stocks can be overvalued or undervalued. And this means two things. This means we can buy stocks cheaper than their real value, and this way we can have higher returns. And buying stocks cheaper than their real value also means we are buying them with a margin of safety, which makes investing safer for us. And it also means that if we buy stocks that are overvalued, we will probably have much lower returns. Because if a stock is overvalued, it means that the future growth is already priced in the stock. Therefore, there is a much lower chance that the price will go even higher. And usually, if there's a big hype around the company and the stock price went up like crazy and it's all over the news, that means that you are already late in the game. So yes, we can predict the price movement of a stock with high certainty, but not by looking at the price chart, by looking at the fundamentals of the underlying business. There are no patterns in the price charts that can predict anything. The price chart doesn't tell you anything, especially in the short term. Of course, nobody knows the future, and even if you analyze the fundamentals of a business, you can never be 100% sure that a business will grow the same way as it did in the past. This is why they say all the time that past performance is not a guarantee of future results. But by looking at the fundamentals, we have a much higher chance of predicting the stock price than those who want to predict the short-term price movement by looking at the price chart.